Hi, good morning, good afternoon, good evening, everyone, depending on where you're joining us from today. Have a really exciting panel for you, really looking at sort of venture capital investing in DeFi with everything going on in the crypto markets today. This is a critical topic on the future of DeFi and sort of the ways that it bleeds into all other verticals. Will really be an important factor in the overall success of this industry. And we have a really great panel here to kind of talk about some of those important issues. So I'd like to let my panelists introduce themselves before we begin. Kyle, would you like to begin first?
Sure. Hi, everyone. My name is Kyle Samani. I'm a co-founder and managing partner at Multicoin Capital. Founded the firm about 4.5 years ago. And we run today a hedge fund and a venture fund managing a few billion across those. And we spend all of our time reading, thinking about crypto, figuring out what we want to buy, buying it, and then not selling it. And it turns out not selling is harder than buying. That's what we do for a living.
That's very true. Thanks, Kyle. Augie, how about you?
Sure. Thanks, Stephen. So my name is Augie. Everyone, nice to be here. I'm an investor with Sequoia Capital. We are a global multi-stage venture capital fund, originally having started in the US about 50 years ago, investing in companies like Apple, Adobe, and Cisco, and more recently, other household names like WhatsApp, Google, Dropbox, Airbnb, DoorDash. When it comes to crypto, we've been investing in the space for the better part of 5 to 6 years, but I would say only seriously and with emphasis over the last 18 to 24 months. I personally cover crypto for Sequoia in APAC, but I have colleagues around the world who also spend time here. So great to be here. Thanks.
Great. And Romit, why don't you tell us who you are, please?
Absolutely. Thanks, Stephen. Folks, great to be here. I'm Romit. I co-lead crypto investments for Lightspeed Venture Partners in India and Southeast Asia. We've been investing in crypto since 2014, have a portfolio of 80 plus companies and projects here. And yeah, much like Kyle, long-term investors holding in for the long term.
Okay, great. So Romit, why don't we stay with you? We're talking about DeFi in this session, and from a VC perspective, I mean, how do you think about what are the key considerations when you're thinking about a DeFi project?
Yeah, Stephen, actually, it's interesting. The framework does not differ as much as it would for any other space as well, and I'd sort of go ahead on that. See, we're a long-only fund. Fundamentally, our bets are driven by a conviction in the opportunity that will play out over a long horizon. So, I think the bull run of the last 18 months, what it showed is that you could make a lot of easy money if you got in early and then sort of sold off your tokens, but that's not been our philosophy. And so the projects that we invested in 2014, we're still invested in them and in fact, doubling down like blockchain.com. So I think when we think of DeFi investing, we think of 3 core frameworks, right? What is the problem that the team is solving and why is that a critical pain point for this ecosystem? That problem has to be the one that takes that ecosystem forward. Why will that team particularly sustain an advantage in solving that problem over a long-term horizon? Now, that fundamentally comes down to the team, their approach, and the pace at which they ship. And lastly, since we're here in this for the long term and we're not flipping tokens, we're sort of really digging deep into why that token economics and why that token particularly captures value, and why does it keep, capturing more value over time. So for example, governance for the sake of it is not an area of interest to us. It's not a good enough answer and it has to be something more. And that's what we really push for. What's the utility and how do you really design that ecosystem around it? When these things line up and you're in the presence of a special founder and a special founding team, that gets us excited.
Okay, great. So, Kyle, one thing that Romit said that I find interesting is sort of like solving the problem. What is the problem as you see it that DeFi solves? Because one of the criticisms that you'll hear about it sometimes is that most people that engage in yield farming, it's purely speculative. It's not necessarily backed by real economic activity. The yields can at times be unsustainable. So what's the core problem as you see it that DeFi is best positioned to fix?
Right. So all of innovation in finance boils down to 2 things. One is figuring out ways to bundle and unbundle risk. And 2 is leverage. And so in some abstract sense, like DeFi is just a set of financial constructs. You can actually argue they're not even really products. They're just mathematical relationships between different things. And so there's kind of sort of nothing to invent, or at least not a lot to invent. And obviously the point of finance is to enable people to basically trade cost of capital and risk preferences for some forms of economic activity. So I would actually argue that kind of the point of DeFi is to support other economic stuff. The core problem that DeFi has faced over the last 18 months has been DeFi rails are very cool and technically quite interesting, but they don't really support any economic activity. So it's just a casino, and it's really just a way for people to lever up using DeFi rails to buy DeFi coins, which like inevitably has some shelf life. Then you add the added problem of liquidity farming on top of that with mercenary capital, and that just creates natural downwards price pressure. So that's basically the story of DeFi in the last 18 months. What's the solution to that problem? You need to get real economic activity flowing over DeFi rails. Pretty unclear how that happens, but there's at least a handful of decent operating theories out there. One is stuff that looks like Goldfinch, for example, for kind of like lending to long tail emerging markets. Another good theory is like DAO native finance, which we're starting to see kind of capital markets emerge around that kind of a thing. Another could be around potentially NFTs and games. So you have, a handful of vectors of things that can produce real economic activity on DeFi rails. Those things are probably not growing as fast as I would say DeFi people would like them to, but they are all kind of growing nicely.
Got it. Thanks. And Augie, I'm kind of interested in your perspective on this. I mean, you focus on Asia Pacific, but obviously Sequoia is based in San Francisco, has a bit of a more global, perspective on things. How do you see DeFi traction and DeFi investing differ based on perhaps like the Eastern Hemisphere versus the West?
Yeah, it's a good question, and I think here in our part of the world, like we definitely still see flavors of kind of core DeFi primitives. Money markets, DEXs, perps, derivatives, etc. I would say the one thing that maybe is somewhat unique to Asia and maybe emerging markets more broadly is we see DeFi products that cater more towards, let's say, the less privileged or lower socioeconomic tiers, right? Especially on the back of this whole play to earn movement that Kyle describes. Axie Infinity, YGG, the ancillary businesses that are cropping up in and around those ecosystems, I think, are quite compelling, right? Like you see certain models that are effectively trying to build financial services on top of, let's say, your MetaMask or your Ronin wallet, as many of these players or users who are starting to earn, let's say, 3-4x their living playing NFT games or in a different light, taking upon these metaverse roles are effectively, and are also unbanked, by the way. 70-80% in certain markets like Philippines do not have access to traditional finance, and thus are using their crypto wallet as sort of a CASA account, and thus having services like, of course, Swap, but also traditional financial services like, let's say, bill pay, mobile top up, also make a lot of sense. And I think we start to see some businesses there, and that to me feels uniquely, if not uniquely Asian, uniquely emerging markets. So we are spending some time on those types of models as well.
Interesting. So Romit, one thing that you mentioned that I want to come back to, because I think it is a really important point when it comes to DeFi, is that you're not interested in governance for the sake of governance. I'd love for you to expand on that a little bit, and it really kind of comes down to, again, like the nature of decentralization. What value does that add to a DeFi protocol that perhaps like a traditional operating structure for a bank or lender may not? And on top of that, I mean, each one of you invests in companies at a very early stage that are highly centralized. There's times when you'll have governance rights, so you can help them sort of chart a course. And at some point, you kind of need to take the training wheels off, hand it off to the community. How do you know when it's time to do that?
Stephen, bunch of questions. Maybe I'll take up the one on decentralization and what sort of it really adds to the thing, to the entire ecosystem. Look, I mean, I think financial disintermediation in general is a massive opportunity, right? And it's led to big outcomes. Like you ignore the price fluctuation, but just look at the case of Robinhood, for example. Massive outcome. And even in that case, right, it's come up recently. It offered very few products, was restricted by geography, but ended up with a multi-billion-dollar valuation. But here you're fundamentally talking about a financial infrastructure layer where you can build an unlimited amount of front ends. It can spawn any kind of financial products that exist, catering to all kind of risk, spectrum of risk, and all kinds of people. This kind of stuff is fundamentally valuable and generational, right? So what essentially decentralization allows, and decentralization, in fact, and composability allows, is the fact that you can keep innovating. And at the same time, it does not put guardrails on who can access and who cannot access that, which also means that, the way DeFi exists today will splinter, right? Experiences that matter for certain geographies will pan out differently from how that play out somewhere else. So a great example that I think of is that in India, where I'm based, your social identity matters a lot. anonymization is not a thing that people aspire for. Like that's a thing, that's a big movement in the US, but that's not something that people aspire for. But if DeFi could sort of intermingle with the real world economy, and enterprises and SMEs in India could access loans at, let's say, 3 or 4% rate of interest versus, let's say, 10 to 15 that they pay here, that's a game changer. Like, you're talking about fundamentally changing livelihoods, and that only happens because this entire system is fundamentally decentralized, right? And that's amazing. Now, coming to your point around, how do we think about governance there, and what about governance token? The point is that your token should have some utility, and it should not be just for the sake of it. That's our belief at Lightspeed. Otherwise, that token is not really for governance. It's more of a customer acquisition cost that you're giving out to your early holders to make sure that they're incentivized and they're not selling it, and maybe allows an exit to a few early stakeholders. And that's not the game you want to play, because that fundamentally will not sustain value over 10, 14, 15 years, whatever a holding period is. So yeah, that is something that we think really deeply about. Decentralization in early days is very, very hard to achieve, probably should not be achieved. It should be some form of controlled centralization where a strong founding team is setting the direction and shipping like crazy so that you can catch up to the incumbents that matter, overtake them in terms of product, and then eventually hand it off more and more parts to the to the community.
Got it. Kyle or Augie, do either one of you want to respond or add on to what Romit just mentioned?
I'll kind of sort of take the other side of that. In general, I think governance is mostly nonsense. You need some notion of governance on like parameterizing a DeFi protocol, because like there's inherent risk in the system, and like it's actually good for the community to weigh in on what risk wants to be socialized across the users of a system. Compound and Aave being probably the best examples of that. Beyond that, I find the rest of the governance to be basically nonsensical. These are, to the extent governance exists for like publicly traded companies, it's primarily the only thing a board does is hire and fire the CEO. So the governance is that. There's really not much governance in crypto around hiring and firing the CEO, so to speak, or the core founders. Because the reality is, if you fire them, like the thing will die, because it's too early stage. So, yeah, I kind of think it's a lot of like optics and not a lot of substantive, hard decision making.
So I'm curious, Augie, I'll give you a chance to respond too. But so, what does DeFi or decentralized mean to you then? If it's not necessarily decentralized governance, like a DAO is the one that is perhaps running it. What does DeFi mean to you, Kyle?
Yeah, like it's. Look, I think it's useful on the margin for tweaking parameters in systems, making decisions like, should you, for example, like what's a really important decision for Uniswap, or you actually say for Uniswap Labs, like should they build derivatives and like build a derivatives exchange, right? Like I actually don't know if they're doing that or not, but like it's a fairly reasonable question to ask, right? And like I would actually argue that is probably the single most important strategic question that you could ask at Uniswap Labs. And like definitively that is not being discussed in the public domain whatsoever. If you ask Compound Labs, like, hey, like 2 years ago, hey, how do you think about, I don't know, multi-chain or whatever? And they were like, we're going to build Compound Chain. And that turns out that didn't work for a number of technical reasons. But like there was a really interesting argument that they should build Compound Chain. And there was a really interesting argument that they should deploy on other EVM chains and perhaps even rebuild natively for Solana. I actually had those calls with Robert and with Calvin 2 years ago and pushed them in one direction. They didn't go in that direction, which is fine. But like those were actually the most important conversations you needed to have. And having those conversations in public is actually value destructive. Yeah. Because like oftentimes the right decisions are unpopular, and like inherently token-based voting is like a popularity contest. Making long, hard strategic decisions should have a very small number of very sophisticated people, like on the order of 3 to 5 people making those decisions. And that unfortunately just does not map to public processes.
Okay. Augie, how about you? What does DeFi mean to you? How does Sequoia think about governance?
No, I think not a ton to add. I think broadly agree with what's been shared. Like my personal view is, and having seen kind of both instances where this can go wrong on either end of the spectrum, right? We've seen let's say governance votes that really the only thing that swings the vote in either direction is 1 or 2 major institutional investors deciding to vote, and that's really the only thing that matters. And we've seen the other end of the spectrum, which is like death by committee, right? Folks sort of opining and voting on sort of the smallest minute details that maybe isn't the most productive or efficient use of time. And I tend to take the view personally that sort of as Kyle described, it depends a little bit on what the DAO is tasked to do and what stage is the protocol in of their maturity, right? So like if it's a maintenance DAO, to use the jargon, and they're simply there and the product is sort of poorly built and they're there to sort of tweak parameters, to use Kyle's language, I think that could theoretically be more decentralized. But if, and we've seen instances like this within our portfolio, if the DAO is tasked with building real product, taking long-term strategic decisions, that perhaps could borrow some lessons from more centralized corporate governance. Not to say it should look exactly like a corporation, but I think that's the area in this whole thing that I find most interesting. Those that are recognizing this whole thing is still an experiment when it comes to governance, and sort of playing and with the model and trying to embed maybe some of the best practices, if not all the best practices, from corporate governance, from what's been built in DAOs in the past, et cetera, et cetera. So I think long story short, we're still observing, but definitely excited to see the experimentation.
Okay. Kyle, go back to you. You touched on something I wanted to just follow up on a little bit, which is sort of what chain is best for a DeFi token. I mean, they all started on Ethereum. Some now are looking to build their own chains or make themselves accessible on multiple chains. And I'm curious, as a VC, like, what's the thought process that you go through when you're looking to invest in a company, or when a company that's already a portfolio firm comes to you and says, look, we're running up against our throughput capabilities, we're thinking of expanding. What are the considerations that go into it? And then on top of it, what impact do you see that having comparatively, perhaps on the DeFi governance token vis-a-vis certain layer ones?
So the most important question is what are you optimizing for? Most people don't have enough clarity in their mind on that, I think. There's a lot of things you can optimize for, some of which are mutually exclusive with each other, some of which are not. That's kind of key. And so when entrepreneurs ask that question, we try and go through that exercise with them.
So what are some of the choices for optimizing that they go through?
So one is gas cost, obviously. One is predictability of code base over time. One is liquidity segmentation. Like, one is, do you have 5 instances of your app? If so, what does that mean? There are certain apps that it's okay to have 5 instances of them. There are other apps that it is not okay to have 5 instances of them. So it just, like, these kind of things vary depending, excuse me, on the nature of the thing being built. To what degree do you value composability with other things? To what extent are you okay relying on bridges? So there's kind of a pretty large convoluted set of questions here, depending on what the thing is. So that's kind of step one of it. I would say, specifically in the context of DeFi, it's actually probably easier to answer this class of questions for DeFi than for most other things. Because, like, generally speaking, the point of finance is composability. Like, you want, like if you make a loan to someone, like, that loan is now an asset on your balance sheet. Like, you probably have a portfolio of loans. You probably want to do something with that portfolio of loans, either rebundle the risk or resell it or lever it up or something. And so composability is quite important. So I generally think that most DeFi things are better off being on a single chain, for that reason, than kind of split across many chains. As you get into an increasing number of consumer-facing applications, the need to be one chain, I would say, decreases. But doesn't mean you shouldn't deploy on one chain, but certainly I think DeFi requires it the most.
Now kind of turn a bit more towards current events. I mean, obviously this is happening in the aftermath of the Luna UST crash. And I mean, Luna, I guess, is trying to reconstitute itself now, but I guess it's probably uncertain to see exactly what's going to happen there. But one of the, I guess, like, the side players in all of this was the Anchor protocol, sort of like the leading DeFi lender on the Terra blockchain, and sort of mass withdrawals from that protocol was one of the real catalysts for the ultimate collapse of the UST system. So I'm interested if you can sort of talk a little bit about kind of what were some of the problems that you saw within Anchor and that system, and just a bit more broadly, what are the types of things that investors, regulators, anyone else, interested parties should look for when they're gauging the health of a DeFi protocol, be it a lender or an exchange?
Yeah, look, I mean, I'd probably avoid getting into too much depth on Anchor. I think that's been commented on by enough number of people. But specifically, I think of DeFi, where depositors, for example, the metric that is often spoken about is TVL, total value locked, and yields is the thing that really draws a lot of early adopters to DeFi. The question to really think about is where are those yields coming from and how, frankly, sustainable they are, right? Mm-hmm. We're not a crypto-only fund. We invest across asset classes, and one of the things is that you can draw parallels in what you've seen in finance to see, what kind of protocols and platforms make sense in the DeFi world. So when we're investing, you're looking for things like utilization ratio, right? Like, sure, you have X number of deposits and X million of dollars deposited, but are people actually sort of borrowing that or not? And if not, why not, right? And if not, and then where are those fundamentally those yields coming from? When you start asking those kind of questions, you realize that, okay, some things are fundamentally sustainable and others will not be for a long, long time. And then it's up to your judgment as an investor if you are okay with that risk or not. I guess few investors are, the others are not. But in general, I think if you're thinking through, what it means for investors, I think everyone will draw their own lessons. But I think the one thing to really think about is to test what is leading, go behind the numbers on what may be defined as a product market fit. TVL alone cannot be a product market fit. Number of wallets depositing something cannot be a product market fit. Evaluate the business on its whole. And I think that's important because nothing is too large to fail if it's fundamentally built on unsustainable legs. And I think that's a great lesson for us to remember. And the other thing is you also sort of owe it as a moral, just as a moral responsibility. You don't want to dump your bags on retail and essentially be in a position where people have lost their life savings because you were sort of shilling a particular token, and that's not the position you'd want to be in. So I guess it just calls for more caution, more humility, and evaluating businesses to really understand if they're hitting their product market fit or not.
Thanks, Augie. So the sustainability is an important question, especially when it comes to rates. I mean, Anchor was promising 20% yield, which I think most people would agree was unsustainable, and it turns out they were certainly subsidizing it to try to gain traction. But rates across DeFi have continued to be highly elevated when compared to traditional funds. Obviously, yields will change based on supply and demand, like anything else. But do you have a sense of what makes for a sustainable yield? And also, just given the current macro economic climate where rates are now going up around the world, how might that impact the yields offered by various DeFi protocols?
Yeah, sure. I can maybe first take it at a conceptual level, and then I can give a couple of examples of spaces that at least we find interesting today. I mean, at the highest 10,000 foot level, I think basic, sustainable yield comes from, in my opinion, yield that has an intrinsic trade-off for the earner, right? In other words, there shouldn't be a free lunch if you are earning real sustainable yield, of which, just as Romit cited earlier, I think payment in kind token emissions, I would not classify in that way. And so there are certain categories of yield like underwriting risk premia, protocol revenue as an example, that I think are sustainable in some sense, but I mean, as you described, Stephen, fluctuate based on demand and usage. At the end of the day, in most of these instances, you still need to make a market. You're still typically making a directional bet, for example, even with underlying protocol revenues. And so from that perspective, it may fluctuate, though it is, I would say, more sustainable than some of these other sources. In terms of specific categories of areas of interest, I'm spending some cycles looking at yield, for example, derived directly from block space. Whether it's products like liquid staking or other derivatives. I think that's a very interesting space, spending some cycles there. The other is the category that Kyle mentioned earlier, which is maybe I'd broadly categorize as real world yields, like lending to non-bank financial institutions, a la Goldfinch. I think those models are also quite interesting, and we're spending some cycles there.
Great. I know we only have about 1 or 2 minutes left, and I want to finish by just asking each one of you to sort of give like one piece of advice, with the caveat that this is not financial advice, to people listening here today that are thinking about investing in DeFi, getting exposure, participating in some of these protocols to help sort of make the best decisions for themselves? Kyle, why don't you go first?
I think the most important thing is examine assumptions. People present a lot of stuff with oftentimes kind of glaring over assumptions in there, and you need to kind of peel back what people present and look for the assumptions presented.
Okay, what's one assumption that you think is worth?
I'll highlight the obvious one with Terra, which is like, if users no longer want UST and start redeeming it, what happens?
Mm-hmm. Okay, Augie, how about you?
I'll actually borrow from Romit if that's okay. And I think asking the second order questions is important, even for your typical retail investor. Again, not financial advice, but TVL, what is driving that TVL? Is it the right metric to even look at given the model of the business? And I think those sorts of second order questions, concentration, incentivization of liquidity, become important. So just dig one level deeper and don't believe the surface level numbers, I think is prudent.
Okay. And Romit, how about you?
Yeah, define your investing objectives. If you're investing in for the short term, chase the hype cycle, maybe you'll be proven right, maybe not. But if you're investing for the longer time, concentrate your portfolio, do your research, build thesis, and then back the best teams building for that space and be prepared for a long hold time. And hopefully you'll see good outcomes.
Okay, great. I think we actually have one more minute, so I do want to sneak in one more question. I'll throw it out to the group, whoever wants to answer. One trend that we are seeing is that there are some more institutionally focused, sort of like walled DeFi gardens. Compound and Aave in particular are trying to make it a bit easier for institutions to get involved. What are your thoughts on that? I'll leave it open to whoever wants to join. Okay, I'll pick someone. Kyle, do you have any thoughts?
Yeah, so in general, I think institutional DeFi, or the idea that, let's say, I don't know, pensions and insurance companies and others will interface directly with DeFi protocols, it will eventually happen, but it actually doesn't need to happen on chain directly, and it is already happening indirectly. The most common way by which it's happening is institutions face a counterparty like Genesis or Compound Labs, and then those guys just put the dollars into these DeFi systems. Turns out that's a pretty good solution for a lot of people. And so the institutional on-chain KYC DeFi thing is a lot less important than I think we would have thought 12 months ago.
Got it. Okay. Well, I think we're out of time. Kyle, Augie, Romit, really appreciate the time. Thank you to all of you for joining, and please enjoy the rest of the conference.